If you're a property developer here in the UK, you know that managing costs is, well, it's everything. But what happens when one of your single biggest expenses, stamp duty land tax, suddenly gets a whole lot more expensive? The old rulebook has been thrown out, and today we're going to break down exactly what that means for your bottom line and, more importantly, what you can actually do about it. And to guide us through this, we're actually leaning on some incredible insights developed by the specialists over at My Tax Accountant. Honestly, these guys are experts at navigating this really complex tax landscape, and what they've put together is crucial for any developer right now. So, let's get straight into it. Let's not beat around the bush. A major stamp duty relief, one that developers have relied on for years, is gone. It has vanished. Now, we're not talking about a small tweak here. This is a fundamental change that could seriously impact your profits. So the big question is, are you prepared for that financial hit? What we're really looking at here is a perfect storm for developers. The tax challenges are just piling up, and understanding exactly what they are is the absolute first step to successfully navigating through it all. You know this already. Stamp duty land tax, or SDLT, isn't just another piece of admin. It's a massive, upfront cost that directly eats away at your profit margins. On any decent-sized project, the numbers can be big enough to make or break the entire viability of the deal. It's often the single largest transaction cost you'll face. Okay, so this is really the heart of the problem. Up until June 2024, Multiple Dwellings Relief, or MDR, was a developer's absolute best friend. It let you average out the value of all the properties in a bulk purchase, which usually meant a much, much lower tax bill. It was fantastic for built-to-rent projects. Well, now it's gone. Your SDLT bill is calculated on the total price, which can push you into much higher tax brackets almost overnight. But wait, it actually gets worse, and this is the part that I think a lot of people are still getting caught out by. Getting rid of MDR was just the first shoe to drop. As we're all now feeling, since April of this year, 2025, the standard nil-rate tax band was slashed in half. It dropped from a pretty useful £250,000 all the way back down to £125,000. And on top of that, the reliefs for first-time buyers were also cut back. So you've got this triple whammy of tax pressure that is now just the reality of the market. Okay, so after all that bad news, you're probably thinking, so what can we actually do? Well, it's not all doom and gloom. There is a powerful, and I want to stress, completely legitimate strategy that savvy developers can use. Let's talk about the forward funding model. So what on earth is forward funding? Let's break it down. In simple terms, it's a deal where a big institutional investor, think of a pension fund or a large investment house, comes in right at the start. They actually buy the development land from you, and then they provide the money to fund the entire construction of the project. You still manage the build, but the key difference is the ownership structure from day one. And this is where the magic happens from a tax perspective. With this model, stamp duty still gets paid, but it's calculated only on the value of the raw land before a single brick has been laid. The easiest way to think of it is paying tax on the raw ingredients for a cake, not the fully finished, decorated wedding cake. All that incredible value you add during construction, it's kept out of the SDLT calculation. Now, theory is one thing, but let's see what this actually looks like in the real world with some numbers. This is where you see just how powerful this strategy can be. Here's how it works, broken down into 3 really clear steps. First, you, the developer, you do all the hard upfront work. You source the site, you secure the detailed planning permission, you de-risk the project. Step 2, you agree on terms with an investor and you legally sell them the land. And then, step 3, that investor funds the build, usually in stages, while you get on with what you do best, actually developing the property.
All right, now check this out. The numbers really do speak for themselves. Let's imagine a corporate investor is buying a completed development for £10 million. The traditional way, their stamp duty bill would be an eye-watering £1.6 million. But with a forward funding deal, they buy the land first for, let's say, £2 million. The tax is calculated on that much lower figure, bringing the bill down to just over £250,000.
I mean, just look at that difference. That is a potential stamp duty saving of almost £1.4 million. That's not a small discount, it is a transformative, game-changing amount of cash that makes your project infinitely more attractive to those big institutional funders who are always focused on tax efficiency. And it's not just about the tax saving for the investor. For you, the developer, the benefits are huge. First off, you get a big injection of cash right at the beginning from selling the land. That massively improves your cash flow. You also get certainty of finance for the whole project, which removes all the stress of trying to secure development loans. And, maybe most importantly, it turns the deal into a real partnership. The investor has skin in the game with you from the very start.
Okay, this all sounds almost too good to be true, right? Well, stay with me because this next part is absolutely critical. Whenever you see a huge tax advantage like this, you can bet that HMRC is watching very, very closely. We have to talk about the anti-avoidance rules.
The big piece of legislation you really need to know about here is Section 75A. Think of this as HMRC's main weapon for challenging these kinds of structures. So understanding exactly how it works is non-negotiable. So what does it do? Put simply, Section 75A gives HMRC the power to look through a whole series of transactions. If they decide that the main reason you structured the deal in a certain way was just to avoid tax, they can ignore all the individual steps and tax you on the final, much higher value. This is precisely why your deal must be built on a solid commercial foundation. So, the million-pound question is, how do you prove your deal has real commercial substance and isn't just a tax dodge? Well, here is your pro tip checklist. You have to document all the legitimate business reasons for the deal, things beyond the tax saving. You need to make sure the land sale agreement and the construction contract are legally separate documents that can stand on their own. And you should be highlighting all the other benefits like genuine risk sharing, better cash flow, or even getting access to the investor's expertise. This is how you build your defense. So you can see, right, while this is a massively effective strategy, it is absolutely not a DIY job. Trying to navigate this level of legal and tax complexity on your own, well, it requires specialist advice to make sure you do it right and stay protected. And you know what? This quote from the experts at My Tax Accountant just sums it up perfectly. They say, "A properly structured forward funding deal is a commercially robust strategy, not a tax loophole." The keywords there are properly structured. Getting the right legal and tax advice from the very beginning isn't just a good idea, it is absolutely non-negotiable. And of course, we have to be crystal clear on this point. Everything we've discussed today is for general guidance only. It is not a substitute for professional advice that's tailored to your specific project and your unique circumstances. Before you make any financial decisions, you must speak with a qualified expert. So, if you're thinking this strategy could be a fit for your business, or you just need some solid advice on other complex tax issues, the best thing you can do is talk to the experts. Get in touch with the team at My Tax Accountant. Their details are right there on the screen. They really have the specialist knowledge to help you navigate this changing landscape with total confidence. So, we'll leave you with this one final question to think about. The tax goalposts have well and truly moved. The environment we're all operating in right now is completely different to how it was just a short while ago. Is your current strategy for dealing with stamp duty really robust enough to protect your profits for the remainder of 2025 and beyond? Thanks so much for joining us. For more expert insights to help you stay ahead of the curve in property and tax, make sure you hit that subscribe button. We'll see you next time.